There are more valuation methods that I can count, so I'll discuss 3 common methods of valuation. Each has pluses and minuses. The most straightforward method is to simply look up the market price of similar items that have been bought or sold recently. This method works best in situations where there's an active market and where items traded are very similar, ideally identical to the one we want to value. A second method is a variation on the first, and it's specific to valuing firms. This is referred to as a multiples-based approach to valuation. Here, we select a performance measure for our firm and try to figure out what firms with similar levels of performance are selling for. For example, we might look at the earnings per share of the firm and determine that similar firms, say firms in the same industry who are growing at approximately the same rate, are selling for 10 times their earnings. We then estimate that the value of our firm is 10 times our earnings. Well, like the first method, this method also relies on finding good comparables, and it puts a lot of faith in that one measure of performance we're using, in this case, earnings per share. The last approach is the theoretically most correct, but it's often the hardest to do. This is called the present value or discounted cash flow method. It requires you to estimate the future cash flows that the asset or liability or security will generate, and then value this stream of cash flows by discounting each one to the present at an appropriate rate of interest. This is the hardest part of employing this method. Estimating the stream of future cash flows that a firm or a new venture will generate, especially those cash flows far out into the future, is obviously a challenging task.